The question on everybody's mind is whether this market has bottomed. As you can see here, we've had a beautiful run. The S&P is up almost 13% over the last month, and that is so refreshing considering the year that we've had, which has been very rough. And as we talked about before, when the market was turning around, you could see that it made higher lows. We put in this higher low right here, and then the market went up and went back to test it, and you can see the bulls came rushing in and bought this up and saved it from going any lower. So this line right here held, and from there we broke through the 50-day moving average, turned around, kissed it, and jumped back off once again. Now, if I'm looking at the S&P, the one area of resistance is almost where it is right now at 4181, or we'll say 4180. That's around where we'll find another resistance and see if we could break through it. If we look at the NASDAQ, that resistance point was shot through last week, and that's a very good signal. Now, if we zoom out a little bit, there's nothing that's saying that this market is going to shoot right back up to highs. We could easily stay in this range for an extended period of time. And if you remember, that was kind of our base case in macro ops, that we were either going to go sideways to lower for the next year. Not that we want that to happen. We all love bull markets, but there is a good probability of that. So that's why even though we're getting this nice rebound, we got to be kind of cautiously optimistic because we could be range bound for a long period of time. Now, Ben Carlson put together some stats to help determine whether that was the bottom. So as of the close of trading on June 16th, the S&P was down 23% from its all-time highs. The Russell and the NASDAQ were down 32 and 33%. So really being that much down, like that's a pretty good bear market, right? And since then, the market has shot up. The NASDAQ is up almost 17% now, and the S&P is almost 13% up, as we said. Apple, which is the heaviest weighted stock in the S&P, is down only 10% from its highs now. And that's because it recovered a massive 25% in the last month. And it was down almost 29% at its worst point in this sell-off. The S&P is now down only around 13% on the year and 6% over the past 1 year period, which feels amazing considering, what we went through this whole year. So again, the question is this the bottom? Well, here's the argument that this was the bottom of the bear market. So one thing we can imagine is that maybe the stock market is pricing in peak inflation. We know last week that the Fed raised rates and the market actually jumped up on that news. And when that happens, it means that that rise in rates was already priced in and it was not a surprise. It was as expected. Or in fact, with this big of a jump, it might have came in better than expected. So considering that in the context of why we're raising rates because of inflation, maybe this bear market and how much stocks have already fallen have already priced in that full scope of what inflation could do. Because we know that markets are all about expectations, right? It's not what's actually happening, it's what we expect to happen in the future. That's what gets priced in the market, and that's why stock prices move. Another possibility is maybe the market is pricing in that the Fed pulls off a soft landing, or that they slow the pace of interest rate hikes. That's a possibility. Maybe it's the bottom because economic output is slowing, but the labor market remains strong, even in the face of 4-decade high inflation. And we know that to be true, right? Every single restaurant is saying they need help. Everybody wants to hire right now. Earnings numbers for the biggest companies are remaining relatively strong. Another factor is that even if we are in a recession or we go into a recession in the coming months, it's likely to be mild and the stock market is forward looking. So I think that second print came out, right? We are technically in a recession. But something that we talked about is that savings rates for households are the highest they've ever been. People are in good shape. And if you watched our previous videos, we've gone over the data to show that people are spending less on goods because the spending on goods kind of shot up during the pandemic, but they're spending even more on airlines and services and vacations and things like that. So even though the numbers might have looked bad, like people stopped spending on goods, it's more of a normalization after COVID when people are outside. And the fact that airlines and spending on those things are increasing, that's a good sign. So even if we're in a recession, people might have enough money to weather through it and continue spending. And if they continue spending, that's what creates a milder recession. Another thing is that the stock market has already priced in all of the risks that are now plain as day since everyone knows what they are, which that could be true, right? This has been one of the most complicated markets with so many factors. You got war, inflation, recession, a pandemic, all these things. At a certain point, yeah, even though it's super complicated, they do all get priced in. And that's when you're going to see the market mellow out. Now, here's an argument that this is just a dead cat bounce in the larger bear market and that we're going to turn around and go lower. So even though inflation might have already peaked, at least in the market, it could be stickier than we think because we know there still are supply chain constraints, right, that are helping cause some of this inflation, along with the war in Ukraine. But the market may be thinking that once these things are cleared out, that inflation won't stay elevated, that it'll come down a bit. But if that's not true and it does persist, that's when you're going to see a big correction in the market once again. Another factor here is that fiscal and monetary policy is now tighter than it's been in years. That's true too. Liquidity is not as good as as it used to be. Another factor is that the Fed could overdo it on their interest rate hikes and cause more pain in the economy than they realize. And I think there's a good chance of that. We've never had a time like this before in history. And the Fed, they're smart, but it's difficult to know exactly what to do. So are they going to manage this perfectly? Of course not. And that's going to cause fluctuations in the stock market. The housing market, which makes up nearly 20% of our GDP, could slow substantially from these higher rates. Because here's the thing, it is very unlikely that the Fed is going to slow their rate hiking. We are going to keep hiking our rates until we control inflation. And we are so behind the curve right now because inflation is so high that it's going to take a lot more hikes. And that will in turn affect the housing market. It's more difficult to buy a house. Another thing is that the labor market is actually a lagging indicator, so it's going to slow in the coming months. Could be true. And lastly, if we do go into a recession, it's possible it becomes worse than anticipated from some exogenous shock to the system. Meaning some unknown happens, something that's not already priced into the market that just sends us for a tailspin once again. That's always a possibility in the market. That's why the market always has risk. Now, currently there are so many conflicting data points, narratives, and opinions that it's difficult to really have clarity on what's going to happen. But also that's kind of always how the market is. Now is especially worse. And like we said in that video that we did about Stanley Druckenmiller in the interview that he recently did. He was talking about how this period right now has no historic analogy, so we are in uncharted territories. And that can be very dangerous because no one knows how it's going to play out. Not that anyone knew before, but at least you had history to tell you, how it's going to rhyme. So as always, the best thing you can do is play your strategy and make sure you have risk control in place. Like, this is a great upswing to play, but make sure you're cutting your losses as they come through, because if this thing turns around, you don't want to lose everything you gained, right? And speaking of investing in a bear market, one question we always get is, when you have a big pile of money, do you put it in the market all at once or do you spread it out? Well, that's a highly debated topic in finance, but we got some data to figure it out. And you know why it's important, because if you're thinking about putting money in the market and you stagger it in, but the market's shooting up, then you're going to be kicking yourself because you didn't put it all in at once. And if you do put it all in at once and the market just turns around and plummets, then you're going to be kicking yourself that you didn't stagger in. So if we look at the data, and this is again coming from Ben Carlson's team, when deciding between investing all your money now, like a lump sum, or over time in the terms of dollar cost averaging, it's almost always better to invest it now, even on a risk-adjusted basis. This is true across asset classes, time periods, and nearly all valuation regimes. Generally, the longer you wait to deploy your capital, the worse off you will be. The only time you're better off by doing the dollar cost averaging is when averaging into a falling market. Now, how do you know that a market is going to continue falling? Of course, if you knew that, you'd be a trillionaire, right? Even more than a trillionaire, if you could predict every move of the market. We do know, though, that the market has an upwards bias. Like, the stock market is up 3 out of every 4 years on average, because at the end of the day, the stock market reflects the economy, and the American economy is the best in the world. So your best bet on average is to invest all of it right now. But again, the only time dollar cost averaging outperforms is in a falling market. But in our case right now, how much has the market already fallen? A lot, right? The S&P fell almost 25%. The NASDAQ was around 33% down. So like we said in the beginning of this video, that's a pretty good bear market already. Could it fall more? Of course. But at this point, when you're already 20 to 30% down, it's not a bad bet to invest in a lump sum if you have it sitting on the sidelines. Because as you could already see what happened in this last month, the market shot up, almost 18% in the NASDAQ. So again, the odds are kind of in your favor in that case, in the case that we're in now. Even though the market has moved up now, it's still a good place to invest. And that's especially true when you're thinking long term. If you're not pulling this money out for 2 to 3 decades, are you really going to be kicking yourself when you invested when the market was 20 to 30% down? No, probably not, because even if it turns around and goes lower from here, in 2 to 3 decades, it'll be back up higher once again, as long as America stays America. But it is good to know, once you crunch all the data like these guys did, investing the lump sum all at once does better for you on average. Now, with this market going up, if you're feeling too bullish and you want to become more centered once again, go watch this video right here. It's the video about Stan Druckenmiller and his view on what's going to happen. It's really interesting, and you'll see why you can be optimistic, but not too optimistic. So click this video, and I will see you there.